Right now, our guest is Dave Derwin from PI Financial, based out of Winnipeg. Dave, how's it going?
Great, Sean. Good to see you again.
Okay, Dave. Now, this is kind of your stomping ground. We're in Manitoba. You're from Winnipeg. You made the drive out today speaking to the audience about kind of the 5 tips, tricks, things you got to consider in your grain marketing plan. What was number 1?
I think number 1 is to have a good, diverse set of marketing tools. So what does that mean? I mean, of course, you've got your cash contracts where you actually sell your grain and turn your hard work and your inventory into cash. But then it goes beyond that, right? I mean, you've got your deferred delivery contracts, which a lot of farmers will use, free up some storage space, book some delivery room, and, price their product coming into harvest. But you also got to look at other things too. Basis contracts, for example, just the difference between futures prices and your cash price. That's an important contract, or it's a very important item to be aware of, because that's going to tell you how your local prices are comparing to the global futures prices.
And I think it's something we often forget about. But it's it's the part of the marketing that has sometimes the most impact on whether or not we have profitability or not. In cattle last year, we had a basis through most of the year that really, really helped out a lot of producers. And so that's a good one. Don't forget about the basis contract.
Yeah, absolutely. And I see a lot of very smart, large, sophisticated farm businesses, and they don't necessarily follow basis. So they even some of those bigger producers still need to keep an eye on it and be aware of it. So absolutely, it's key. It's key.
What is number 2?
Well, that's so number 1 was having your diverse tools, okay, and including the cash contracts, the basis, but then also got to look at futures and options and having an overall hedging program. So that was number 1, having diverse tools.
But be aware, especially when you talk about options, and especially when we're writing options. We got to be very careful what we're doing.
Yeah, and it's like anything, right? Once you learn how to use it and learn how to manage the tool, then it's very effective. So that I think is key, is just being aware and knowing what's out there and having that in place.
Have as many tools in the toolbox, so to speak, as possible.
Absolutely.
Perfect. What's number 2?
Number 2 leads from that is follow the futures markets. I think it's really important to follow what is happening out there, and you want to look at the futures. It covers a lot of markets: wheat, corn, canola, soybeans, feeder cattle, full weight fats, Canadian dollar, but also things like oil and diesel, interest rates. Interest rates are going up, and you can use those markets as well to hedge your interest rate exposure. So follow all those futures markets and be aware that they are out there.
How often?
Oh, well, it depends how much interest you have in it. But I mean, of course, I do it daily for clients. So for them, it might be something where they check in the morning, in the afternoon, at night. Some very rarely, they'll count on me to do that. Others get very involved and like to follow it. But I'm thinking, once or twice a day, once every, a couple times a week, just to see where those longer term, bigger picture trends are going for the markets that you grow.
Well, and self-promotion here a little bit, Dave. A great way to follow what's going on in the markets is to download the RealAgriculture app.
That is an excellent way to do it, Sean.
Okay, what's number 3?
Number 3 is following the spreads in markets, basically prices between the cash level and the futures, and how that relates to storage opportunities, okay? Because we see a lot of storage capacity being built across the prairies, which is great. Gives you a lot of operational advantages and a lot of marketing flexibility. You can store it, you can sell it if you want, but if you got the capacity, that makes sense. But one thing that is missing is you store it in your bin, but you don't necessarily price or protect that higher carrying opportunity that's out there, and a $9.80 soybean price that might be available for 6 months delivery dwindles away unless you do something about it. So you want to be able to capture those higher prices that the market is telling you. Store your grain, we'll pay you for it. But unless you do something with a delivery contract, with options, with futures, you don't actually capture that gain. You're just watching the prices come and go. So storage and hedging go hand in hand.
Well, and sometimes when I'm listening to other commodity analysts here on Rural Radio 147, they'll talk about how, cash is premium to future, and they'll talk about the deferred months, and they give a context to what that actually means. That to me is something where, talking to someone like yourself is really helpful, because you're following some of those historical relationships.
Yeah, and there will be times when there will be a lot of carry in the market, meaning it's very compelling to store, where you could get 40, 50, 60, sometimes 70 cents on a bushel of wheat to store it. That's an extra 10% a year, and if you've already got the storage capacity, why wouldn't you take advantage of that? Other times the cash bid might be nice and high. There's not much. There's no compelling reason to store it. Sell it. Clear out your bins and focus your energies elsewhere. So those prices across the futures curve, from the current month to the deferred month, what's happening in the futures, can help you make better decisions on the farm, for sure.
Hey, nothing wrong with cash in the pocket.
Yeah, that's right. And sometimes that's the best way to go.
Number 4.
Number 4 is know your options, right? Puts and calls. Okay, at the end of the day, options are really just like price insurance. Okay.
Yep.
But just like futures, it allows you to protect your price. But the big benefit is you don't have to. You can separate your delivery decisions and your pricing decisions, right? Because typically, if you go to an elevator, you sell your grain. You're even on a deferred basis, you're still locking in. You're committing your grain to that market. So when you separate that, it gives you a little bit of flexibility, right? You can price something if you like. If you don't like it, use options, protect it. Give yourself the downside risk that you can take care of, but it gives you the upside potential if markets go higher.
Now, okay, so when we talk about options, we have to keep it simple. Is that we don't need to get into these crazy, elaborate, exotic option strategies? Is that the best way to look at it? At least not at the start.
Right. Yeah. Especially if you're new to it, you want to understand it first. And options are just price insurance, basically. Okay. And sometimes the market will dictate that just buying a simple put is the best way to go. Oftentimes there are different spreads that you can look at that give you the protection you're looking for. Maybe it reduces the cost a little bit.
Yeah.
Okay. So you want to let the market dictate it, and it doesn't have to be complex and all these wild positions, because that typically isn't the best way to go. Well, trying to keep it simple is good.
I remember I took finance in university. I remember being in like 4th year derivatives class, and they would have all these strategies. For some reason, one just popped in the condor.
Yes.
I remember. I don't know why I'm remembering that now.
Yeah, I haven't used that one in years, because typically it's not the kind of strategy that's going to apply to an operating business. For arbitrage purposes, that might be the case, but computers take care of that now. We're looking for some of those bigger picture moves and those bigger picture opportunities.
Okay, what's number 5?
The last one, and I think this is important, especially given where the Canadian dollar is right now, is separating your currency decisions and your commodity decisions.
Interesting. Okay? Explain.
Okay, so canola. Yeah, it's traded in Canadian dollars. The futures are, and you can go and price it. But even canola, just like wheat and soybeans, they're all priced globally, really, right?
Yeah, very much so.
And you look at, if you can separate a time when maybe the price for the futures contract on, say, wheat or soybeans is really quite high, you might want to take advantage of that and protect that level. But the currency might be at a level where it's still drifting lower and lower and lower, as we have seen pretty much all of 2018. So just locking in at the elevator, you're also locking in your currency.
Okay.
Right? Because you're giving up any potential of a weaker currency. Now we're sitting here, Canadian dollars at 75 cents US, which is near the low end of the range it's been for the majority of the past decades.
Just kind of floating along.
Yeah, 75 cents, 74. So all of a sudden we're at a low level, which might make you say, you know what? All my revenue, whether it's pulse crops, specialty, cattle, grains, whatever, it's impacted by the Canadian dollar. So my top line revenue, 100 cents on every dollar, is impacted by currency. Currency is low right now. Ought to look at hedging your currency price separately than your commodity price.
Hey, the Canadian dollar has been that insulating factor for Canadian farmers. When you compare our farm profitability levels to the U.S., it's the Canadian dollar that has really not bailed us out, but it has insulated us from harm.
Yeah, absolutely. I've crunched a lot of numbers on that, and if it wasn't for that currency, our land prices probably would have come off a little bit like we saw in the States. Some of the profitability levels and revenue levels probably would have come off too. So you're right. The currency is important across everything you do.
Yeah, you gotta. Those are 5 great things to keep in mind. I think a lot of times sometimes we make it just too complicated, and sort of sometimes if we make it complicated, what happens is we get sort of paralyzed in thought.
Yeah.
And I think if I was to add just one, the overarching all of that is that have a plan. Like, know what your objectives are. Is that do you see that a lot where people come in, they don't really know what their objective is right off the hop?
Yes, and having a marketing plan is going to incorporate all these different tips because you're going to want to have options and futures in the toolbox. You want to follow basis. You're going to want to know what futures prices are doing. What options? When is options make sense to use and when doesn't it, right? Currency, following that. So it's all part of the marketing process, and unless it's built into the plan, it's too easy to miss.
Hey, Dave, this has been a lot of fun. Thank you very much. Good luck with your talk here at Manitoba Ag Days, and we'll talk to you again soon.
Thank you very much.